What is going on, guys and girls? It's the Short Bear, and today we're going to do a members only video, basically answering every kind of question you guys had in chat. I asked you last week to ask your questions and to put them in the Short Bear Fundamental video tab. Alright, so let's get started right away. The first question we got was, hey bro, could you explain why S1 is better for dilution than the S3? That would be amazing. Now I feel like some people are, kind of unsure about the S1 and the S3, how they work. And they always think one is better than the other. But in reality, it's not really, there's nothing really better than the other one. They're kind of a bit different, right? I feel like the S1 is a bit better or a bit more precise regarding the timing of the offering that might come. In that way, it might be better, because you can time it better. But for the dilution process itself, it's there's really no real better one than the other, because it really depends on what is in the specific S1 or S3, right? So let's talk about what the S3 is and what the S1 is, right? So first of all, we've got, I always tell you guys there are three playlists in the Short Bear Fundamental video tab, right? The Early Bear Show, the one-on-one series, and the Digging with Short Bear, right? The Digging with Short Bear series is more, in depth about specific tickers, specific examples, specific topics that I wanted to cover that I feel like are pillars in my, complete approach to the market. The one-on-one series is going to be, more basic, more, kind of topics that I feel like every trader should know as a fundament for their strategy. It doesn't really matter which strategy you have. All right, so the one-on-one series is going to cover topics like bid, so what the bid is, what the level 2 is, what the really basic stuff is, right? But there are other things. So we just said, what is the S1, what is the S3? There is a video in the one-on-one series that explains to you which type of filings there are, the most common ones. So if you don't know anything about filings and what, the filing might mean, check it out. But I wanted, nonetheless, to go into the S1 and to the S3, all right? So I wrote some things down on Evernote here, so, I've got it really kind of structure for you guys. The S3, all right, is the most simplified SEC registration statement available to make an offering. All right, an offering means basically that you are offering new securities, meaning it could be, stock, so common stock, it could be warrants, it could be other things, right? So basically, you want to issue new shares onto the market that are not yet there. So, that's the most common way for a company, or the easiest way really for a company to get more money. I mean, there are other things, like loans and so on, but this way we can really take advantage of it compared to the loans. So compared with an S1 filing, an S3 filing does not require the issuer to provide as much information, all right? That is the main thing why companies would take an S3 over an S1. One of the main points, not the main one, because, they don't have to be so, open about everything. Most companies we trade are really crappy, really shady, so an S1 will require them to just make a lot more public, basically, right? What an S3 can do, what an S1 can't, is a shelf, all right? So you could basically, you're gonna post an S3, all right? You're gonna say up to 200 million dollars, I mean, and what they can do from there is do multiple raises. So you're gonna release a 424B filing, which is the filing you're gonna use if you want to take some off the shelf, and make an offering. The thing is, most companies can't really raise exactly what they want because they are restricted by the baby shelf rule. The baby shelf rule, I mean, I explained it in probably 5 to 10 videos already made for you guys, so I'm not gonna go too deep into it. All right, I've got this website. This is the link I always share with you guys. It really explains plain simple how the baby shelf rule works, and that link is going to be in the description, all right, for you guys to check it out. But nonetheless, let's talk a bit about the baby shelf. All right, so when companies want to raise, they need, first of all, an S3 or an S1. Those are two filings they need to basically offer new security onto the market. They need it, all right? They can't offer just security out of nowhere. They need to file one of those two things, and on both filings, they're going to need an effect filing, all right? So that if an S1 or an S3 is posted and they don't have the effect, or no matter what, they can't raise off of those filings. All right. The next thing they need for an S3, for example, is they need to check out how much they can even raise. If a company's MVPHS is under 75 million, they are only allowed to raise 1/3 of that amount. Now, what is an MVPHS? The MVPHS, all right, is a number. That number is calculated by multiplying the float with the highest price, the highest closing price in the last 60 days. All right, if that price is under, or that number is under 75 million, they're only going to be able to raise 1/3 of that. So picture a company with a 5 million float and a $5 highest close. All right, you're going to take that 5 million times 5, that's going to give you 25 million, and they're going to be able to raise 1/3 of that, which would be 8.33. And that is the amount they can raise from the S3. Now from there, if they have the effect on the S3, they're going to be able to put out a 424B5, for example, which is the filing they need them to basically take that number, that what they can raise, the 8.33 million, and they're going to take it off the shelf basically, and are going to be able to issue those new shares if they have, of course, an underwriter, so another person, an entity that will basically pay them money to get the shares or whatever, right? The common stock, the warrants, whatever. So that is how you're going to raise from an S3. Now, one thing you need to also check out with the S3 is, did they raise within the last 12 months, right? So let's say after the calculation we just did just before, 25 million, so the 5 million float, the $5 highest closing price gives you 25 million, and they can raise 1/3 of that, as the MVPHS is under 75 million. In this case, the MVPHS is 25 million. All right, so 8.3 million. If, for example, they raised already from that S3 within the last 12 months, let's say 2 million, right, of the shelf, so the S3, they're going to be able to raise the 8.3 million we just talked about minus those 2 millions. All right, so you need to check out if they raised within the last 12 months, because you need to subtract that from the amount they can raise from the baby shelf. Now, that is how you can really easily check out if a company can raise or can't raise. All right, it's not super complicated. You need to check it out, and that's going to be the process for me every single time if I see an S3 and I'm wondering, all right, can they raise, right? An S1 filing is a bit more difficult, right? So the S1 filing primarily is going to be used for an IPO. So when a company goes public, all right, they offer the first shares onto the market, the pricing and everything is going to be laid out in the S1. All right, so it is most of the time, so if the company wants to go public, they will need an S1, all right? They are going to use the S1 for the initial public offering, which is the IPO. Now, an S1 can also be, so, you know, when you have an IPO, right, the IPO is basically you offering, you know, your first shares for the market. So it's basically an offering, right? It's not that different, all right, to raising money. It's basically the same thing in a sense that you are offering shares for a specific price, right? And the S1 can be used not only for the IPO but also to offer new security once the stock has IPO'd and everything. So basically, the difference between an S1 and an S3 is the S3 can be used multiple times, right? You can basically take something off of the shelf. That's why it's called the shelf. An S1 is different. You can use an S1 once and that's it. Once you raise from the S1, you will not be able to use that S1 again. Now, the S1 is more difficult because you need other information. So on the cover page of an S1, you're going to have different things, all right? You're going to have information about the issuer of the offering, so the legal name, the state of incorporation. That means a company will be filed, it will be incorporated in a specific state, and the states have different rules, all right? So if you want to be a really dilutive company, you're going to look for Delaware, Nevada, or states like that, right? And that needs to be in the filing. Other things like the SIC code will be needed to be on the cover page, the tax ID number, the address, the telephone number of the issuer's executive office, and the maximum amount of security proposed and to be proposed in the offering, and the registration fee, as well as the approximate date of the commencement of that offering. Right, those are the things that will be on the front page. And usually the S1, what you're not going to see really on an S3, at least not as it's not as common, is going to be that the S1 will be needed to be amended a lot more. All right, so you're never going to see really an S1 and then they get the effect and they it's done basically, right? Usually, the S1 is going to be amended once, twice, maybe 3 times. Not much more than that. I mean, we've seen it before, but not much more because they need to change a lot of things, right? Through the time, they're going to need to, change a few information things, and the amount, the date, and so on and so on. The registration fee, it all needs to be basically amended. So the S1 is going to be posted normally, and then it's going to go to the SEC. The SEC will review everything, the information, look if everything is fine. They're going to get back to that company, and the company is going to change a few things, all right? Then the S1 will be amended, so you're going to see S1/A, all right? No matter what filing, if a filing needs to be amended, you're going to see S1 or S3/A, which means amended, right? The issuer cannot lie, all right? So I see a lot of people saying, all right, but what if they just, state something that isn't true? What will happen, right? Of course, some companies will lie, all right? There are outliers, especially companies that are filed somewhere else, like China and so on. So for China and all, the S3 is going to be named another way. It's going to be called an F3, F standing for foreign, and the S1 is going to be called F1, all right? And but nonetheless, they are not allowed to lie. So if they lie about something, they're going to be liable for that, and they can be prosecuted because of it, right? Now, what is better with the S1? Better, right? What is different or better in the sense that we want more dilution is the S1 is not subject to the baby shelf rule, meaning let's the example we just had with the 5 million float times the $5 highest closing price within the last 60 days is not going to be used with the S1. With the S1, you can raise as much as you want within the parameters, of course, of the authorized shares you are able to issue onto the market, and a few other rules. But basically, it depends on the state you are in. As I told you before, there are lists. I don't know them by heart, but basically there are different rules for different things. Now, this is going to be it for the S3 and the S1. So let's get on with the next question. All right, the next question is the level 2 stuff, right? I mean, there are definitely a lot of questions in here talking about, can you do a level 2 video? Can you talk about this and that, right? Doing level 2 videos is extremely hard because the thing is, I'm trading, right? I'm not only, in chat, kind of telling you guys about trading and kind of, trying to tell you about my approach, but I'm also, a real trader, and I trade every single day when the setup is there, of course. And it's really hard for me to, record everything, be in a trade, and trade with size, and at the same time look at the level 2, show you guys with the mouse, whatever, what is happening, and managing my positions at the same time, right? Especially because most of the time the level 2 is, you're not gonna have um, let me formulate it another way, right? So the level 2, most of the time the stock will be choppy, it's going to move sideways, and then you've got those specific points within a few seconds where you have an edge with the level 2 where all right, that might happen, the probability of it happening is higher, and that doesn't happen every single second. You can't be, all right, in, out, in, out. I mean, some people do, but it's not my style at least. So what I'm going to do is, of course, if you guys don't look at my videos, you're not going to be able to, pick up the little things I tell you here and there, right? During the mic sessions, I talk about level 2 and what I see. In the early bear show, right, when I traded, a bit live with you guys, talking about, what I'm in, what I saw and all, I talk about the level 2. With the digging with short bear and the trades and what I see in the tape before I enter, I talk about that as well. So look at the videos. That's going to be the biggest tell, and I'm going to try to make a video. I mean, Max has really, really nice videos about the tape, where he live trades, so check out those videos, alright? But I'm going to try to put something together. I mean, I've told you that for at least a month, and I'm still working on it, so it's a lot of work to get, the footage and everything. Alright, so the next question is basically, go over, or the next question or statement is, go over the live trade and discuss where your eyes are, what you're looking for, what you're expecting, what contradicts the move. I mean, that is, subjective, meaning every single stock is different. There are other things I'm looking at, but primarily I'm looking at the data, right? The data, that's pretty much, the main thing. That's the thing I'm looking at every single day. I track everything. I keep on telling you guys, you need to track, and that's why we made the webinar about tracking. If you guys didn't, see it, it's in the Digging with Short Bear playlist right here. That's where my webinars are. We talked about tracking and how to track, right? If I know the specific setup I'm looking at, let's say an all-day fader, right, gaps up an average of this and that, tops out at an average time of 7:30 a.m. or whatever, right? And I'm gonna get a 20% fade on average, and a spike at 9 a.m. back, a bit of retracement to the upside, and on the open I'm likely to get an 8% spike or whatever. That is what I'm looking at. I'm looking at those specific areas, and within those areas of interest, I know a stock is likely to reverse. That's where I'm going to be looking at the level 2 and looking at the sellers. So what I'm going to be looking at on the level 2 is going to be, the stock is moving up, it's moving up, and then all of a sudden, the ask is basically showing something like 100 shares and is absorbing 5,000 shares. We break over it, but like 1 cent higher, we've got the same problem, and it keeps on, trying to hit you. You don't see anyone, but someone is absorbing size, someone is selling basically. And the best thing you can see from there is basically a big bid. So let's say someone is showing 10,000 shares. People are kind of, panicking, and they try to buy, but it doesn't make it. And then when we go back to that big bid and the big pulse, so, it's fake, or he gets taken out, that is where I want to enter, risking that higher level structure, basically where the sellers are at. If we start absorbing again, despite, the selling and the bidder failing, and we start reclaiming, I'm gonna cut, as easy as that. But it gives me a super nice edge because I've got my data basically, and I've got the sellers, and the tape, the chart, basically confirming the thesis that I had for that specific stock, right? And of course, that is only the technical part, and everything before the dilution part and the fundamental part is a big part of my trading as well, as you guys know, right? Every single stock I trade has a fundamental thesis, news thesis, and everything else that comes with it, right? You know that I am that type of trader that really looks at everything before taking a trade, and I'm looking for the bigger trades, right? I'm looking for 20, 30, 40, 50, 60% return within that one specific day, or overnight, of course, for plays like APDN or things like that. Next question. The logistic of using the short trade borrow and how to keep bullets and why. Also, mental stops on short positions in case of a super spike or mental stop, and how to range CPU with Thinkorswim. There are some ideas that have causing me a headache. All right, so I'm gonna answer everything. So the logistic of the short trade borrow and how to keep bullets and why. That is a good question, I think. Well, what I like to do, my broker has pretty much everything available regarding, borrows. I mean, we rarely don't see any borrows, and if the borrows are not available, so the locates are not available right away, usually they reload during the day and I'm able to get the locates I want. So I don't really have a problem with, to think about, do I need to take more right away, or, should I basically take what I want now and then locate more? I don't really have that problem, and I'm really happy that I don't have this problem, and that is exactly why you guys need to think about what your broker is, basically. So which broker you're going to go with, because it really depends on the broker. Some brokers are going to have nothing, some other brokers are going to have something in the morning and then nothing else, and that's why I chose my broker, basically. So regarding bullets, I don't really use bullets. If something is really really hard to borrow and I know I want to hit it hard, I'm gonna have more shares reserved, so I take the locates, basically I pay for them, and then I'm gonna be adding. But usually what I do is I borrow what I want right now, where I know, all right, I'm gonna get my entry, and then the first bounce is gonna be where I want to add size into, risking basically my average. That's how much I'm gonna get. If it starts really unfolding exactly like I want it to and further than I want, I'm gonna be looking to locate more, basically. All right. Regarding mental stops and hard stops, I am a big fan of hard stops. I know some brokers out there are not good with the hard stops. All right, it's going to take a lot of time before they execute you. Even 1 second is too much, basically what I like to do for any single trade I have is basically I'm gonna have my level, right? The risk level I want to risk off of, and I'm gonna have my, oh shit, I need to get out stop, right? So if something comes out like news or something and the price just skyrockets or just plummets, right? You need to have a plan for that, because you can't be there thinking, oh, my stop is gone and I didn't cover, or I didn't, sell. What am I going to do now, right? You need to keep in mind every single trade you take might have more risk to it than you might think. And you need to be absolutely alright with cutting the position if that worst case scenario happens. Now, it's not going to happen often, but for me, for example, it happens 1 to 3 times per year on average, where it's like, a stock gets news out of nowhere and it skyrockets, right? And I'm short big size. And that is why I like to have hard stops at specific levels, where it's like, it's not the hard stop, at my mental level, but it's going to be at a higher level. And if it just takes off, and I just don't look for a second, I look back and the stock is $1 higher, whatever, I'm gonna be stopped out. So that is why I think mental stops and hard stops are so important. And you need to use the hard stops as a tool of complete destruction. I need to be out of that trade. I don't want my emotions to be part of it. I know if it gets over there, there is no reason to be in it. Regarding CP and Thinkorswim, I am not with Centerpoint. Right, for you guys, I don't know, Centerpoint is a broker, a partner broker of Manage Money. They have a tab as well. I don't think you can kind of incorporate both, so you're going to use Thinkorswim as a charting platform and CP as your broker. They are using different things, right? CP is with DAX Trader, the charting platform, and Thinkorswim has, their own version. All right, so that's going to be it here. I'd like to get more info on convertible notes. All right, that's going to be a specific video because that is, a video that will take at least 30 minutes to an hour to explain exactly what is going on there, and there are, exceptions and so on. So it's going to be a broad theme. I think that deserves a specific video for that. When your entries come close, do you tape read or watch the level 2? If so, what do you look for? Again, I answered that question just before, right? Where it's like, can you make a video about level 2? So I'm going to be looking for, selling pressure, hidden selling pressure, refreshing orders on the offers, on the ask is another word for that, and best case, a big bid that tries, to scare shorts into covering, but it just, absorbs everything on the offers and slams back down into that big bid that then disappears or it gets completely filled. That is what I really like to see. And from there, on the way down, what I want to see is basically refreshed offers and hidden size on the offers. So we trend down, try to pop, but it's like super heavy, and even if there's, a big offer of like, let's say 10,000 shares, he gets filled, we get, you expect a lot of panic, but it just, stops. It just gets slams back down to that other level and then continues. That is what I want to see. That's what we saw on those plays, so RF, Vive, or TX, all right, and that's exactly what I do. Now, someone wants to hear about my pre-market routine. Again, guys, I've got a lot of videos. Check out the content. The Early Bird Show is a show that I made a while ago, where it's like, those are the mic sessions, all right? Those videos are in there, and the Early Bird Show is the show that I started when I did the videos and I talked on the mic live in the morning, all right, pre-market, and that is where I showed you exactly what I look for in the filings, and how I attack everything. So the Early Bird Show is there to show you my morning routine. I might do another episode of that because the videos are not really getting old, it's a couple of months, so it's still really recent, but doing another one would be a thing that I would be interested in for you guys. If you guys want it, of course, tell me in chat. All right, could you please talk more about the cash flow, how to calculate it, how much money they have left, also the difference between S1 and S3, how high they need the price to be, and so on and so on. So the S1 and the S3, we talked about that, but one thing I didn't mention for the S3 filing and S1 filing, sometimes you're going to hear me say, they've got an S3, they can raise, but I think the price is going to head higher. Now, why would they want the price to be higher? Well, because of the NVPHS, right? So the float times the highest price. If they move the price up to a specific level, right? If they're near that 75 million NVPHS we were talking about, they might try to get over that, right? So let's say you've got a float of 25 million, right? And they are at, 260, 270, getting near, that $3 level, right? The $3 level, so close over that $3 level will put them over the NVPHS, and they won't be subject to the baby shelf, meaning they can raise as much as they want, right? That would be a thing I would be looking at, and that is exactly why he wrote how high the price needs to be, because if they get it over that price, they are not subject to the baby shelf anymore, and that is going to allow them to dump as much as they want. Now, cash flow, how to calculate it, and how much money they have left. Let's do that on just a basic example. So let's pull up BAM SEC, right? And we're gonna do just whatever RF, just because I saw the ticker. So from here, I'm going to be looking at the nearest 10Q, all right, and I'm going to hit Control F and look for cash, all right. So the cash is going to show me how much cash they have left. That is the most liquid asset they have, in that case 44.9 million, all right. That number, you want to write it down, and you want to write down the date of that statement regarding the cash. Right, so you're going to write down 44.975 on your sheet as of September 30th, 2019. Then you're going to hit Control F, and you're going to be looking for cash flow in that case, and that is going to give you the cash flow statements. All right. And what you're going to be looking for here is you're going to look for the net cash used in the operating activities, in this case 12 million, and you are going to divide that by the period. All right, so here 9 months ended September 30th. So that is how much they burned during that time period, so the 9 months before September. So you're going to take 12 divided by 9, which would be 1.4, I think. Alright, so they burn 1.4 million per month cash, and then you're going to look back at your cash basically. Alright, so here 44 million, and you're going to look at the time. So September 30th, is going to be the time. You're going to take every single month after that, alright, from September until now, basically, which gives you, the specific month number, and then you're going to multiply that by the cash burn that we just, calculated via the cash flow statements. And what it's going to give you is basically how much cash. So first of all, through that number here, how much cash they burn on a monthly basis, and through basically multiplying the amount of months until now, you're going to get basically how much cash they burn in that time period as whole, and of course how much cash they have left. Now this company, for example, they have enough cash, but on other companies, you're going to have maybe even a negative cash, right? So where it's like they don't have any money left, and they have that S3 that is out, it's effective, they can raise, they are allowed to raise via the baby shelf rule, they have some left, and so on, and then they're going to be able to raise. So that gives you a good idea of when they might raise and if they can raise. So that's kind of what we cleared up today so far, right? Now, VIVE, ARAB, ONTX messed up the dilution this week. Can you maybe talk more about those? Again, I did videos, so specific videos, deep dive videos about VIVE and ARAB. ARAB, I talked about it last week during my weekly recap on YouTube. And VIVE is one I did a video about a few weeks ago, I believe. So not that specific run, but basically APDN has exactly the same setup as VIVE had, where it's like you check out the cash, burn, you look at the filings, and you see they don't have any cash left, and they have an S1 that has been amended a few times, and within that small time period of 1 week they amended it 3 times, for example, and alright, the offering is going to be hitting the market, and that's exactly what we get every single time. And if they want to do the offering, what they're going to do is they're going to gap it up, they're going to short as much as they can, and once the offering comes and the price is going to drop, that drop is usually not because of dilution, it's basically algos and people selling basically because of the offering, and through the short that they had, they're going to make money on the downside. So if it gets down because of the offering, they are going to be hedged shorts, they're going to be making money, and if it heads higher, they're going to make money with the offering basically. So next, a few times we've seen you refer dilution that in that moment I interpreted as being already present in a company's stock. Would you share how dilution that may already be present before stock gaps can affect the way in which you would expect the stock to trade for that day? Now, dilution is the process of issuing new shares onto the market. Now, before that, the underwriters are going to give money to the company, and the company is going to give them shares. Before that, they have the shares, but they need to sell into the market to basically make a profit out of it, right? So you want to check out the 44B5s, which is where the dilution is going to be. So for the example of ARAB, you're going to be looking at the 44B5, and you're going to see, all right, that is, for example, an offering, right? It's linked to the S3, I believe, and it's 25 million at a price of $7.50, right? That only gives you basically on the offering itself, but you want to check out after that. You want to go to the 10Q basically, and then you're going to type in if those were warrants, you're going to type in warrants or whatever, and you're going to be looking for a table or basically what is written down, and that is going to give you basically exactly how much basically is left from that offering. So you want to always check out the 10Q. Now in the 10Q needs to be more recent than the 44B5 to have the information in it, because if the 44B5 came out after the 10Q, you won't be able to basically know what has been happening in that time, right? So a 54B5 from March here is going to be came out before the 10Q, which means the info should be in there if they dumped it, if they didn't dump it, and so on and so on. Same with an ATM, etc., right? So if the dilution is still there, that's going to be great. If the price, of course, of that dilution is higher than the stock price right now, it's not going to be used, because they're not going to make a profit out of it. They might short against it to make money on the short side, but that's it basically. Now, people mention there's an offering coming up and the price either plummets or I believe most will expect it to. Sometimes, however, it seems like the price has soared because of the offering, and I'm thinking I'm using this correct terminology here, right? Yes, you do. Would you talk about some best practices used to hypothesize the direction of the stock pursuant to these offerings? All right, so sometimes, best example, KRTX last week, where it's like a stock gaps from $10 to 30 and moves to 100. Usually, with small caps, the price of the offering is going to be really bad, right? It's going to be at what we call a discount. So if the price is trading at $2 and out of the sudden, you've got an offering at $1, right? That is a 50% discount to the market. So the price that the market felt like being, the right price, the fair price, is now 50% lower regarding the underwriters, right? So the underwriters are only willing to pay 50% of that stock basically, which is a very bad sign, right? Because they're not really wanting to pay the price of the fair price the market participant closed the stock at, right? So that is bad, because basically everything that $1, so from $2 to $1, that is 100% profit for the underwriters if they want to dump, right? If they can dump. So that is why the stock plummets. Now, other cases is basically, so KRTX, for example, right, never traded at 100, or at least not within the last few years, and then all of a sudden, we spike, and there's an offering at, the stock price closed at 110 or whatever, and the offering price is at 100, right? It's still a $10 discount, but the stock never traded at those prices, and now all of a sudden, underwriters, so investors and so on, are really willing to pay basically the price, the fair price, or near that price, right? That shows you there is some real money, there is some real capital flowing into that stock at higher price it we never traded at. And that shows you that, it's not only all smokes and whatever you call it, right? But like, it's not all smokes. It's basically a real price. There is some capital behind it, and they're really willing to pay that price, and that is a really, really good sign for a company, right? So you always need to think, you don't have to think offering is a bad thing, right? An offering at a discounted price with bad terms, that is bad, but an offering itself is not bad. All right, so that clears it up, I think. As we discussed it in the other day in the chat, manipulators simply striking deals to make sure shares are available to short, which haven't actually been issued yet. Would you share your knowledge about such tactics and how to identify them? What information can we extract from that data, and how is it useful in strategic planning? Are there resources online to learn more about it? No, there aren't. All right, so resources online, you're not going to find anything. Same thing about basically everything in the market, right? The marketplace is really, trying to sucker you into the buy the breakout kind of thing, right? Sell the breakdown, because the big money is basically, trying to make you believe that they need volume, right, on the breakouts to basically sell. As you know, most breakouts fail. It's not all clear. They basically use what most people think to basically make money off of it. So there aren't much resources to learn about it online because it would, endanger them. Regarding issuing shares that are not available yet, let's say they've got an S3, right, without an effect, or an S1 without an effect, and then people I start seeing on Twitter, whatever, yeah, the new shares, they make them available to short, whatever. It's not true. Plain and simple, it's not true. What a company can do, so they need the effect for those shares to be available. But before that, they can't do anything. The only thing they can do is basically short against it. That's the only thing. But I think what you're kind of mentioning, or what you mean, is more like, so when shares are hard to borrow or easy to borrow from one day to the other, and so on and so on, right? What underwriters want, there are two main things, right? If you want to move a stock up, you're going to make it easy to borrow. Now, for more beginner traders, whatever, you might think, but wait a second, if they want the price to go up, why would they make shorts, so shares to short, available? Well, because it's far easier to move a stock up with shorts basically stuck. If you know a stock doesn't have any value, and you want the price to move up, and the stock is hard to borrow, so no shares are available, it's gonna be all buying, right? They're gonna need to buy the stock up. But if shares are available to short, what they can do is basically they let the stock tank, all right, to a lower price. They absorb those shares, the shorts, right? And they spike it up. So they make it go in a sideways, whatever, and they spike it up. And during that spike up, right, shorts are getting out, and the manipulators are able to basically sell into the covering pressure, so the buying pressure of those shorts getting out, which means they buy lower and they sell higher, and they move the stock up while doing it, right? Which gives them a better edge. Now, usually the best faders happen when it's hard to borrow, because what they do when it's hard to borrow is basically short against that stock, so hedge offerings or whatever, and they short the stock. They make it hard to borrow because they're not looking to move it up. They're looking to short. So the less shorts are out there, the easier it is for them to basically build a position at a better average. All right, so let's see. I would love to have a peek at your daily screen setup if you're willing to share. I don't have that right now because I'm using another computer, but I can share it with you guys, no problem. I'll post it in chat. Now, do you use hotkeys with your trading software? I can't remember if you said something in an old video or not. Mind sharing your hotkeys of choice. Now, previously, I posted a hotkey PDF here. Everything is in there for most of you guys. I wanted to have, hotkey for everyone, kind of understanding exactly what you can have, what you can't have, routes, and so on and so on. But I personally use really, easy hotkeys. So I've got basically I've got F1 until F12, right? I've got basically short a specific amount, all right, on F1, F2, F3, F4, all right, 4 different share sizes, and it's going to be taking liquidity basically. So it's going to be hitting the bid, and then I've got F5, F6, F7, F8, which is going to be basically providing liquidity. So I want to be on the ask, basically, same thing.